Hello everyone and welcome back to Bot Concept. So today we'll be talking on risk management. What is risk management and why it matters? What is position sizing and size in such a way that you never blow up another trading account? So this topic I'm about to share with you is very important, so pay close attention. If you are new to the channel, consider subscribing and hitting the notification bell so you stay updated to our latest content. Risk management. So first and foremost, what is risk management? Risk management, if you ask me, is the ability as a trader to encounter series of losses and not blowing up your trading account. For example, even if you sustain a series of 10 losses in a row, your trading account should be pretty much intact. Yes, you can have a bit of loss along the way, but your account should have most of the money intact. So that is what we call risk management. And that is what risk management is all about. So let me share with you some few examples. So let's say, for example, James and John both have a 1 and they have a 50 winning rate. So this means they win 1-to-2 ratio. So let me explain what risk reward ratio is. So let's say, for example, you risk $100 on a trade. Okay, that's the amount of money you're willing to lose on a particular trade, and the outcome for you is favorable. Instead of losing the $100, right, the market went in your favor and you made $200. So in other words, the 200 is 2 times the amount you had intended to risk. So this is what we call 1-to-2 risk reward ratio. Let's say you have a 500 risk on a trade, and instead of losing the 500, the market went your favor and you made $5,000 instead. What is the risk reward ratio on this trade? The risk reward ratio on this trade is 1:10. At $500, you made $5,000. So this risk reward ratio is 1:10. Next, James risks $250 per trade and John risks $250 per trade. Let me say the outcome of the trade for both of them is in this sequence. Earlier stands for lose, 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 win, 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 win in this sequence. You can see that James loses first 250 because the trade is a loser, and another 250, another 250, another 250, and then he ended up blowing up his account. So before you could even smell the winner, he lost the entire trading account. On the other hand, let's have a look at John. As you can see, John goes through the same loose stake, made 40, 40, 40, 40, because these were the streams of winning at the end. But why 40 again? Because we have 1:2 risk reward ratio for this trading strategy. So if John risks 20 on each of his trade, and the market, or rather if he achieve 1-to-2 risk reward ratio, this means a profit is 2 times his initial risk. So 2 times of 20 is 40. This is how we got 40. And at the end of it, John made a total of $80. So that is about 8% gain on his account. Whereas you look at James, he actually lost his account. Hopefully, using this simple example, you can see how important risk management is. In the case of both traders, they are trading with a winning strategy, but because of risk management, one of them loses his entire account and the other one made some money from the same trading market. So risk management is important. Another question you might be thinking or wanting to ask: how do I manage my risk? How do I make sure that every time I put on a trade, I don't lose everything and more? So that is where the next topic comes into play: position sizing. So what is position sizing? It's simply like trading the right number of units such that even if a trade ends up being a loser, it's only a fraction of your account. Okay, let me repeat once again. Position sizing is knowing right how many units you should trade such that if the trade goes against you, you only lose a fraction of your account. And as general guidelines, I usually advocate not to lose more than 1% of your trading account on each trade. So for example, let's say if your account is like a $10,000 trade account, 1% of $10,000. So this means every trade you put out on, you should not lose more than $100 on each trade. So you might be asking yourself, right, how do you calculate in such a manner that where you know you won't lose more than 100 on each trade? So to do that, you will need to know a few things. Okay, this is kind of a secret formula. So position sizing is equal to the amount to risk, right? The amount of dollar you're willing to risk divided by your stop loss, multiplied by your value per pips. So the amount you are willing, usually I recommend 1% risk on each trade. Some traders will go with 2 or 3%. That's pretty much. You know, up to an individual trade, and after which you divide it by your stop loss, multiply by your value by pips. So I'm going to share with you a very simple way to do this. Okay, I will just go with you a manual way, and after that I will show you how to do it with a faster way. Let's say you are willing to risk $100, and let's say you know your stop loss is, let's say, 100 pips, and your value per pips for a standard lot, let's say you are trading Euro USD, is 10 per pips for a standard lot. Okay, so when you plug in the numbers and you divide by 1,000, you end up with 0.1 standard lot, which is equivalent to 1 mini lot. So the trouble with this is that your value per pips is constantly changing. It really depends on your currency code, depends on the account funding that you are funded with your account. So you can see that things can really get cumbersome. So one thing I would suggest is to make use of a position size calculator. So you can Google position size calculator and make good use of the ones. It's free. It's actually free. So let me do a quick recap. Number one, position sizing is the tools to manage your risks, and use a position size calculator, right, to make life easier. Like I said, use a position size calculator to make life easier. I don't expect you to manually do it. Most brokers usually have it inbuilt. Most brokers usually have inbuilt calculator functions. If it doesn't have, then you just have to go to any free website via Google, and you can make use of the calculator to help you calculate most of your trading unit. Even if the trade is losing, trading right, you only lose a fraction of your account. So thank you for watching. See you in our next video.